I bet you didn't know how powerful value investing can be. Today, we're diving deep into the world of value investing. We're talking about the strategies used by legends like Warren Buffett, the kind of strategies that can potentially set you up for long-term financial success. Value investing is about patience, discipline, and finding those hidden gems in the market. So if you're ready to ditch the hype and learn how to build real wealth over time, buckle up because we're about to break down value investing step by step. We'll explore the principles that have stood the test of time and how you can apply them to your own investment journey. From understanding intrinsic value to analyzing financial statements, we've got you covered. So, grab a notebook, get comfortable, and let's get started on this exciting journey into value investing. Before we jump into picking stocks, we need to understand the philosophy behind value investing. It's all about finding companies that are trading for less than their intrinsic value, basically, what they're actually worth. Think of it like finding a hidden gem at a flea market, a vintage Rolex being sold for the price of a Timex. Sometimes fear, hype, or misinformation can cause a company's stock price to drop way below its true worth. And that's where value investors come in. We're like those savvy shoppers at the flea market looking for deals that everyone else has overlooked. We'll dive deep into financial statements, analyze key ratios, and learn how to separate the undervalued diamonds from the overhyped rocks. It's about finding those fundamentally strong companies that are built to weather any storm, no matter how rough it gets. By mastering this approach, you'll be well on your way to making smart, informed investment decisions. All right, let's talk numbers, because understanding a company's financial health is crucial in value investing. We'll start with the price-to-earnings ratio, or PE ratio for short. This tells you how much investors are willing to pay for every dollar of a company's earnings. A lower PE ratio compared to its industry peers could indicate an undervalued stock. Next up, we have the price-to-book ratio, or PB ratio. This compares a company's market value to its book value, which is basically its net worth. A PB ratio below 1 could suggest that the market is undervaluing the company's assets. Remember, these are just a few of the many metrics we use to evaluate a company's financials. Another important metric is return on equity, or ROE. ROE measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. By understanding these key financial metrics, you can make more informed investment decisions. Now that we've got a grasp on some key financial metrics, it's time to roll up our sleeves and dive into fundamental analysis. This is where we really get to know a company inside and out. We're talking about dissecting their financial statements, the balance sheet, income statement, and cash flow statement. We'll be analyzing key ratios like return on equity, ROE, and the current ratio. But fundamental analysis isn't just about crunching numbers. It's also about understanding the qualitative aspects of a business. Remember, we're not just buying stocks, we're buying into businesses. So, you've learned the basics of value investing and how to analyze a company's financials. Now comes the exciting part, finding those hidden gems in the market. One way to do this is by using stock screeners. These tools allow you to filter stocks based on specific criteria, like low price-to-earnings ratios or high dividend yields. But remember, screening tools are just the starting point. You still need to do your own due diligence and dig deeper into the companies that pique your interest. Another way to find undervalued stocks is through qualitative analysis. This involves reading industry reports, following company news, and even checking out their competitors. The more you know about a company and its industry, the better equipped you'll be to spot potential opportunities and make informed investment decisions. All right, so you found a company that you believe is undervalued. But how do you determine what it's actually worth? That's where valuation comes in. One common method is discounted cash flow analysis. This involves projecting a company's future cash flows and discounting them back to their present value. Another method is the dividend discount model, which is specifically for companies that pay dividends. Now, valuation is not an exact science, But by using these methods, we can get a ballpark estimate of a company's intrinsic value and compare it to its current market price. The goal is to buy stocks trading at a significant discount to their intrinsic value. In value investing, we're not just looking for good companies. We're looking for good companies at great prices. And that's where the margin of safety comes in. Think of it as a buffer zone, protecting your investment from potential downside risk. The margin of safety is the difference between our calculated intrinsic value and the current market price. The wider the margin, the safer the investment. By buying stocks at a discount, we're essentially leaving room for error in our analysis. This provides a margin of safety, which we'll discuss in the next chapter. Don't put all your eggs in one basket, diversifying your portfolio. Even the best value investors make mistakes. That's why it's crucial to diversify your portfolio across different sectors and industries. If you invest all your money in a single company and something goes wrong, you could lose everything. But if you spread your investments across multiple companies, you're less exposed to the risk of any one investment tanking your entire portfolio. Diversification helps to mitigate risk and smooth out your returns over time. A well-diversified portfolio might include stocks from various sectors like technology, healthcare, financials, and consumer goods. Remember, diversification is key to long-term investment success. The patience game. Why long-term thinking is key. Value investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. The market is constantly fluctuating, and it's easy to get caught up in the short-term noise. But remember, we're not traders, we're investors. We're looking for companies that will compound our wealth over years, even decades. Don't panic sell when the market dips. The longer you hold your investments, the more time they have to grow. Stay ahead of the curve. The importance of continuous learning. The world of investing is constantly evolving. That's why it's crucial to stay informed and educated. Read books by legendary investors like Benjamin Graham. Read books by legendary investors like Warren Buffett. Follow reputable investment blogs. Follow reputable investment podcasts. The more you learn, the better equipped you'll be to make informed investment decisions. Investing is not a set-it-and-forget-it activity. It's important to regularly review your portfolio and make sure your investments are still aligned with your goals. At least once a year, revisit your investment thesis for each holding. Rebalancing your portfolio ensures that your asset allocation stays in line with your risk tolerance and time horizon. It needs to be nurtured and adjusted over time. One of the best ways to improve your investing skills is to learn from those who have come before you. There's a wealth of knowledge to be gained from studying the strategies and philosophies of successful investors. Start with the classics like The Intelligent Investor by Benjamin Graham. Dive into the letters to shareholders written by Warren Buffett. Don't just read these books. Study them, learn from the greats, and build upon their wisdom. You don't need a fortune to start investing. In fact, it's best to start small and gradually increase your investment amount as you gain experience and confidence. Many online brokerages allow you to open an account with a small minimum deposit. Start by investing a small amount that you're comfortable with and gradually increase your contributions over time. Remember, investing is a marathon, not a sprint. The most important thing is to get started. So there you have it, guys. We hope you enjoyed this deep dive into value investing. We've covered a lot of ground today, from the fundamental principles of value investing to the importance of patience, discipline, and continuous learning in your investment journey. Remember, value investing is about finding those hidden gems in the market, those undervalued companies with solid foundations that are poised for growth and success. It's about being patient, doing your research thoroughly, and investing for the long haul. Start by educating yourself. Familiarize yourself with the key metrics and analysis techniques, and don't be afraid to ask questions whenever you need clarity. Like this video if you found it helpful and informative. Subscribe for more investing tips and strategies, and hit the notification bell so you never miss an update from us. Until next time, happy investing and stay informed.